Welcome to a presentation of Hughes Federal Credit Union's Power Over Debt, Break the Debt Cycle. My name is Elsa Jackledge, and I am the lead business development representative here at Hughes. Now I'm going to turn it over to our business development representative to start our seminar.
Hi, I'm Irlanda Cuevas, and we're delighted you've joined us for this important program to help you get and stay out of debt. So let's take a look at the presentation. This seminar is geared towards individuals who are already in debt, as well as those who wish to stay out of debt. The purpose of the seminar is to give you valuable tools to manage your personal finances and your debt during good times and bad. So let's take a look at the objectives. Be familiar with different kinds of debt. Know your benefits and cost of credit. Identify warning signs that you have too much debt. Improve your credit report and score. Take steps to tackle your debt. Avoid pitfalls, rebuild good credit score, and stay out of debt. So what is debt? Debt is money that you borrow with an understanding and agreement or a contract that you'll repay the funds. Not all debt is bad. There's good debt. Those are considered investments, such as a house. There's also student loans or small business loans that can also be considered investments. Along with this webinar, we'll be providing our handouts. Please take a look at handout number 1, Where Are You Now? So let's get back to the basics. What's the definition of credit? It's a short-term loan that allows you to make purchases now with the promise that you'll pay it back at a later date, usually monthly. If you don't pay it back in full, then you're charged interest. And then what are the types of credit? There's installment versus revolving and secured versus unsecured. Debt is first categorized by whether if it's secured or unsecured. Secured debt means that there's collateral or security on the loan that the lender can take if you don't make the payments. Unsecured debt does not have any collateral. The most common type of unsecured debt is credit cards. Debt can also be categorized as being installment debt or revolving debt. Installment debt is sometimes referred to as a close-ended loan, and revolving debt is sometimes referred to as an open-ended loan. Installment debt means you are making a monthly payment for a certain or set amount for things such as a car loan, a student loan, or a boat loan. And then what are the benefits and the conveniences to buy now and pay later? It's cashless, it's widely accepted, it has a rewards program, ID and personal data is not required, you get a monthly statement or a record of your purchases, and if you pay it in full, you get an interest-free loan. On this slide, we'll see the warning signs that you have too much debt. You're paying your bills late. You're only making minimum payments. You're at or near your limit on all your credit cards. You don't know how much you owe. You use cash advances to pay other bills. You're denied credit and credit purchases. You get calls from collection agencies. You lie to your spouse and your family about your debt, and more of the total income going towards debt. So if you're experiencing any of them, take steps immediately to get yourself back on track. But if you're experiencing more than one of these warning signs, consider visiting our credit union to see how we can help you, or we can help you make the appropriate referrals. So on this slide, it's an excellent example of what the cost of poor credit history does. It's the best way to explain why it's important to have good credit history. So let's take out this auto loan example. Let's say you need a car loan for $14,000 and you finance it for 4 years. Depending on interest rates at the time you need the loan, let's say you get it at 5%, which also varies depending on where you go. But at 5% interest, for example, your monthly payment will be $323 and you'll pay a total of $15,504 for that $14,000 loan. But if you have a poor bill paying history, you will have to pay a much higher interest rate. In this example, the person pays an interest rate of 14%, and they pay $60 a month more than the person with good credit, which amounts to a total of $18,384 over those 4 years. So the person with poor credit in this example paid almost $3,000 more on the same car. Now, what is a credit report? A credit report is a record of your bill paying history. Like it or not, if you pay late, that black mark could end up on this report, and it could mean the difference between getting good interest rates and getting costly ones. And who can look at it? Anyone with a legitimate business interest can look at it. Some examples are potential lenders, insurance companies, landlords, and even potential employers. And you can get your credit report at annualcreditreport.com. Again, the website is annualcreditreport.com. And what does the credit report say about you? It tells potential creditors and employers whether you have a lot of outstanding loans, how good you are at repaying your debt, and how high your credit limits are. It tells whether you have court judgments against you, such as child support payments or lawsuits, and whether you filed for bankruptcy in the past 7 or 10 years. It has some personal information, such as your name, your address, social security, date of birth, and jobs you've held, but it does not include anything about religion, race, or political preference. And we'll talk a little bit more about how you can improve your credit. So what is a credit score? Your credit score is a number that represents your credit worthiness. How likely are you to repay the loan? The higher the number, the better. What's a good score and what's a poor score? The average FICO credit score is about a 693 according to Experian. Typically, anything higher than a 760 is considered a very good credit risk. If your score is lower than, let's say, a 600, you likely will be charged higher interest rates, but it varies by the lender. And how can you improve your credit score? There are several things you can do to improve your credit score, but be aware that it may take time to see the improvement. Let's look at specific components of each credit score on the next slide, which will give you ideas on how you can improve it. Here are the 8 steps to tackle your debt. Step 1, know what you owe. 2, change your credit card habits. 3, find extra cash to pay off your debt faster. 4, know your pros and cons of your 401k loans. 5, consolidate some debt. 6, choose methods to pay down your debt. 7, contact creditors. And finally, number 8, get help. So now let's take a look at each one individually. Step 1, know what you owe. The very first step to tackling your debt is know how much you owe. You can use handout number 4 so that you can make your own list. What you'll do here, you'll add up all your total amount of your debt, including any loans, as well as your monthly payments. Be sure to write down the interest rate on those debts. Next, calculate your debt to income ratio. This is your total monthly payments divided by your after-tax income. That's your net income. For example, if your monthly payments minus your mortgage or rent is a total of $275 and your monthly take-home pay is about $1,900, that means your debt to income ratio would be 14%, which is healthy by any standards. Generally, a debt to income ratio less than 15% is considered good, and you probably manage your money quite well. If your debt to income ratio is between 15 and 25%, use caution. If it's higher than 25, you need to seek help. But for ratios higher than 35, you're in the danger zone, so make sure to get help from our credit union. Step 2, change your credit card habits. Stop using credit cards, get rid of high-rate credit cards, and break bad habits. So if you're serious about getting out of debt, the second step is tackling your debt is to not add new debt. So stop using your credit cards for a while until you get back on track and you can make those monthly payments in full each month. Limit your spending to the bare necessities. Second, look at handout number 4 and based on the interest rates, decide which credit cards to keep and which ones to get rid of. Your ultimate goal here is to keep 1 or 2 credit cards that you've had the longest and that have a relatively low interest rate. Shop around for cards with low interest rates and low fees, and start by asking what cards are issued at our credit union. Third, try to understand how you got into debt trouble in the first place. Do you have the urge to splurge when you're troubled or depressed? Are you unable to resist a sale even if it's an item you don't need? By understanding why you're overextended while taking steps to reduce your debt, you're greatly increasing your chances of long-term success. Step 3, find extra cash to pay off your debt. Here you will find your ways to tackle your debt is to find that extra cash so you can pay it off faster. First, establish a budget. Set up a spending plan. We have our basic budgeting seminar along with this webinars for additional information. You can also do your withholding. So if you've been getting a large refund every year, you have been giving an interest-free loan to the federal government. Instead, make sure to adjust your withholdings on your W-4s by adding exemptions to increase your take-home pay. This way, you have access to your money all year round instead of getting a lump sum at tax time. Consider redirecting your retirement contributions, but only temporarily, just to pay down your debt. Be careful and check in with a financial advisor at our credit union to see if this option is right for your situation. You can also consider taking a part-time job and make that extra income to help pay down that debt. Or you can also liquidate some assets to put towards debt. Some examples include a garage sale, Craigslist, eBay, or consignment shops. So now I'm going to turn this over to my coworker, Elsa, who will guide you into the next slides.
Step 4. Use 401k loans with caution. As you tackle your debt, use caution when considering borrowing from your employer's retirement plan. On the surface, a 401k loan appears to have some advantages over a traditional loan. The pros are there's no application form and no credit check. You can borrow up to 50% of your vested amount or $50,000, whichever is less. If you repay on time, the loan is shielded from taxes and penalties. The cons are the interest you pay yourself on the loan is taxable. If you lose or quit your job, you must repay within 30 to 60 days. If you do not repay within 60 days, you'll be facing a 10% penalty plus state and federal taxes if you're not age 59 and a half yet, and this would be considered a premature withdrawal. Step 5, consolidate some debt. If you have a lot of credit card balances, you might be tempted to take out a debt consolidation loan. This strategy involves taking out a new loan and closing old credit accounts after using the debt consolidation loan proceeds to pay them off. Make sure the interest rate is less than what you are paying on the loans you are consolidating. The pros are, if you consolidate 5 accounts, you'll only have one payment for all the debts instead of 5 separate payments. The cons, your credit score could suffer, your loan payments are stretched out over time, and there likely will be a higher total cost to repay the outstanding debt. You could lose your house if the loan is secured with home equity. You could get into credit card trouble all over again if you just keep using credit cards. You may be paying interest on debt that was previously interest-free. Examples are legal or medical bills. Step 6. Choose method to pay down debt. There's 2 methods to pay down your debt. The first is the power pay method. This is the most effective strategy for paying down debt, as you put as much money as possible towards the highest interest rate debt first, while making minimum payments on all other debts. Another strategy, which is often referred to as the snowball method, it's not quite as effective as the power pay method. It's where you make minimum payments on everything except the smallest debt and focus on getting rid of the small debt. Once it's paid off, you apply the extra money to the next smallest debt, and so on. Use the second method as a backup plan if the power pay method doesn't work for you. The most important thing is to choose a method that works for you and stick with it to get rid of your debt. Step 7. Call your creditors. If you can't pay your bills or you think you're going to have a difficult time in the very near future, the worst thing you can do is to ignore your creditors. Call them before they call you. Making a good faith effort can go a long way towards positive resolution of your money problems. Make sure you agree on a repayment plan that's reasonable and affordable for you. Some questions you may consider asking creditors, would you be willing to lower my interest rate? Or would you be willing to reduce the total amount of my debt? But before you make the call to negotiate a repayment plan, know what you can afford to pay given all of your other obligations. Don't agree to any plan that you know you can't afford. If you negotiate a repayment plan, definitely stick with it. Step 8, get help. If your discussions with creditors break down, ask for help from the credit union. Our staff can refer you to reputable counselors or agencies to intervene with creditors on your behalf, such as the Consumer Credit Counseling Service. Be aware, though, that some credit counselors may require that you cut up all or most of your credit cards. Bankruptcy should be used only as a last resort because it'll be listed on your credit report for up to 10 years. It's visible to anyone granting you credit and resulting in a higher interest rate and much higher interest payments over time. Bankruptcy is a costly option. Bad credit. Avoid pitfalls. You can't erase bad credit history. You might be able to temporarily hide some negative information on your report, but be prepared for it to show up again. Negative but accurate information can stay on your credit report for up to 7 years. Avoid advance fee loans. Never pay a fee just for the promise of a loan. This is a sure sign of a scam. Steer clear of rent-to-own stores. These agreements typically result in payments that are 2 to 3 times more than the item is worth, and they may have been repossessed. Payday loans are expensive, short-term loans against your paycheck, with annualized interest rates that could be more than 700%. Payday loans have been outlawed in Arizona, but lenders are finding ways around this. You won't be offered anywhere near close to an item's value at pawn shops. Debt settlement is a process to settle outstanding debts with creditors, but the costs are high and there are pitfalls. This remains on your credit report for 7 to 10 years, and you will owe income tax on the amount that's been discounted. 5 don'ts. In addition to the pitfalls on the previous slide, remember these 5 don'ts as you develop your plan to pay down debt. Don't ignore your debts. Call your creditors before they call you. Don't carry your credit cards with you if you're prone to impulse purchases. Don't ask for credit limit increases because you may be tempted to charge up to that limit. Don't use credit for consumables such as food, because if you carry a balance from 1 month to the next, you're paying interest on food you ate months and months ago. Don't use credit repair agencies because they charge high fees for things that you can do for yourself for free. No one can erase history. Tips to rebuild your credit history. Here are some useful tips to rebuild your credit history and get back on track. If you're having problems getting approved for any credit, consider a secured credit card through the credit union. Collateral is usually in the form of a deposit account. The amount in the deposit account usually determines the limit on the secured credit card. Accounts are much easier to obtain as they present no real risk factor for creditors. Use that line of credit responsibly. Pay off balances on time to establish a good bill paying history, which enables you to get forms of credit in the future. If you need to close unwanted accounts and are not planning on applying for credit in the next several months, you can write a letter asking to close accounts. Get help. Ask the credit union staff for referrals to credit counselors, either in-house or with reputable counselors in the community. And you can also consider consolidating some debts. Next, we have 10 steps to stay out of debt. We've talked about different kinds of debt, the cost of having a poor credit history, ways to tackle your debt, pitfalls to avoid, and tips to rebuild a good credit history. This slide explains how you can stay out of debt. Some ways are building an emergency fund, tracking spending, You can use budgeting to trim spending, figure your credit limit, charge responsibly, keep your utilization rate low, automate it, get off of mailing lists, know your rights, and pay your bills on time. Tips to lay a solid foundation. The best way to establish and build a good credit history is to lay a solid foundation and to have the right tools in place. Open a checking account at the credit union and use it responsibly. Don't bounce checks. Apply for only one store, retail, credit card, or a card from a gas station. Then, to establish a good credit history, only charge as much as you can afford to pay in full each month. Other ways to establish a good credit history include getting a small loan and paying it back promptly and having a mix of credit over time. Build your resource toolkit. We've covered a lot of topics in a relatively short period of time, including different kinds of debt and how to determine if you have too much, how to improve your credit report and score, how to start tackling your debt, ways to avoid the pitfalls of credit, how to rebuild a good credit history, and most importantly, 10 ways to stay out of debt. To help you dig deeper into these topics for your own situation, look for tools online. We encourage you to build your own resource toolkit as you gather more information. Add to the list, print the ones you find most useful, and start a file that you can access quickly if you need it. Make it yours. You may even want to add some categories such as budgeting, savings, or investing, topics that weren't covered in the seminar, but that will help you with your overall personal financial goals. Develop your personal action plan now. Our goal for this seminar is not only to give you tools and information you need to help you improve your credit situation, but to help you develop a personalized plan. This is based on your needs, your credit situation, and your goals. From the discussion today, list action items you plan to take and a date when you plan to complete them. Write your action items and dates in pencil because you may change your mind. You might want to reprioritize, make adjustments, or you may decide that you need a second page. Consider this list your personal roadmap that will lead you down the path of getting out of debt and staying out of debt. And now we have our resources for financial literacy.
So on this last slide, this is our financial guide, and I will take you to our website so that you can navigate it yourself. So you will go to hughesfcu.org, and then you will click right here on Financial Guide. This will take you to our webpage while it gives you the tools and support that you need for financial independence. Our first one here is our financial calculators, which is a great tool that can help you see how much you can afford to borrow for, let's say, a mortgage or a car loan. Money Coach at Hughes is an excellent platform for adults. These are 10-minute modules. They're compatible on all mobile devices and available in English and in Spanish. It helps adults feel free to go on to online personal finance training that helps build financial assurance. We also have Money Coach for students, which is a lot like Money Coach at Hughes. These are also modules that help students and young ones how to prepare for the future. It helps them save up to $2,000 for college. It talks about entrepreneurship and economic concepts. We also have HFCU Financial Services, and these are amazing financial advisors at our credit unions that can help you with anything from retirement to paying for college. And then we have our webinar series, and we will be having more webinars coming up. So if you have any questions, any comments, or concerns, please contact us at marketing@hughesfcu.org. Again, that email is marketing@hughesfcu.org.
Thank you for participating today. It has been our pleasure to bring you our Power Over Debt seminar virtually. Look for our next seminar, Creditability, coming soon.